I'm Mr. Singler. We are Team Star. My name is Calvin. This is my team, Jessica, Tim, Hardeep, and Mo. We're here today to discuss accounting issues for our client, Leung Limited. Our agenda for today begins with discussing the control issues that we have identified. Second, we will be discussing significant accounting issues. And last, we will finish the fraud identified in Loan Shark.
The risk identified is the use of post-dated checks. MLI currently receives its initial advance of funds plus interest via post-dated checks from customers on their next payday. The funds may not be available in the account when the check is deposited. Further, the company already has issues with tracking down customers, so retrieving the funds after a check has been rejected becomes even more difficult. We recommend that MLI utilize a system of pre-authorized debits, which the vast majority of banks today provide, in order to confirm that the account information is legitimate. MLI should run a test by attempting to withdraw a nominal amount from that customer's bank account. Once the customer has approved automatic payments into their bank account, MLI will be able to repeatedly request payments from that account until sufficient funds are available. Customers will be forced to pay a stop payment fee to their bank account in order to stop these requests.
Another control issue identified is currently the company does not screen potential employees prior to hire. For this reason, the company's employee turnover rate is very high. The company is in the business of handling and lending money. Not doing background checks on potential employees could cause serious security issues for the company. Additionally, by having a high turnover rate, the company is unable to train their employees adequately so that all company policies are enforced properly at all times. Our recommendation for this issue is that the company should implement a hiring and screening process using an agency such as BackCheck that conducts thorough confirmations of references and criminal record checks for potential employees. Furthermore, as per company policy, payday advance checks should be deposited first thing in the morning as they become due. However, they are only being deposited twice a week due to the company being short-staffed. As customers are generally short on money, they try to withdraw money from the bank as soon as they get paid, increasing the likelihood of LSL not receiving their payments on time. This issue's recommendation is in line with most recommendation where a pre-authorized debit system would eliminate the need to physically go to the bank every day and deposit the checks, as the debit would be automated for the payday of the customer.
Next, I will be discussing accounting issues. Firstly, we'll talk about revenue recognition. LSL is in the lending business and is recording the full amount of cash advance to the customer and interest earned as revenue. However, the cash advance appears to be a loan rather than revenue. Also, revenue is recorded at the time the funds are advanced to customers, while there is still a high level of uncertainty surrounding the collection of that loan. Jacob Gray is in the process of selling his franchise location either back to the franchisor or to a third party. There is incentive to increase revenues by recording the full amount of the money advanced to revenue and accounts receivable as soon as possible to receive the highest purchase price. IAS 18 states, when others are using assets of the entity, it gives rise to revenue in the form of interest for charges for the use of cash or cash equivalents or amounts due to the entity. The cash advance shouldn't be classified as revenue because customers are simply using the LSL's asset, which is cash, and repaying the amount back to a later date. Therefore, the full amount of the cash advanced cannot be recorded as revenue, just the interest portion. The remainder is simply a loan which is recorded as a financial asset. The second issue is when revenue should be recorded. IAS 18 states that revenue arising from the use by others of entity assets yielding interest, royalties, and dividends shall be recognized when it is probable that the economic benefits associated with the transaction will flow to the entity. This criteria is not met as there is a high level of uncertainty surrounding the collectability of cash advanced and relating interest revenue due to the nature of the business and current economic conditions. Also, in the current year, 50% of promissory notes are past due and the majority of the customers fall into the low income bracket, further increasing the uncertainty surrounding the collectability of both the loan and relating revenue. IAS 18 also states that the amount of the revenue can be measured reliably. Revenue is based on a fixed rate of 20% of the advanced amounts, therefore it can be measured reliably, and this criteria is met. We recommend that only the interest earned on the money loaned out should be recorded as revenue, and the amount of the actual cash advance should be recorded as a financial asset on the balance sheet. Due to the nature of the business and uncertainty surrounding collectability of the loans and relating revenue, revenue should only be recognized when the interest payment from the customer is collected, because only one criteria required by IFRS is met. The following need to be made as adjustments to accounts receivable to remove the portion of loans receivable from accounts receivable. So with the current accounts receivable balance of about 1.07 million, we need to remove 80% of that of the amount advanced, which is $856,720, which will leave us with an AR balance at the end of the year of $214,180. The accounting issue we will discuss is that of the donation. Jacob has recorded a donation in the operating expenses of Loan Shark to a hospital where his son works, hoping it will help his son obtain full-time employment. Because this is clearly not a business expense, there is increased risk of the government auditors identifying the expense, disallowing it, and flagging the company for potential future offenses. We recommend that this transaction be recorded as a debit to Jacob's shareholder account. The Loan Shark will not receive the additional operating expense. However, Jacob can still claim the donation personally and receive the charitable donations tax credit. The adjusting entry we would make in this case is a credit to the operating expense for donations of $17,100 and a debit to Jacob's shareholder account for $17,100.
Jacob has not been recording a bad debt allowance in the current year, even though historically bad debts have been equal to about 10% of paid advances, and this year 50% of promissory notes and AR are past due. Due to the type of clients and nature of the business, the collectability of their advances are not reliable. IAS 39 states that an entity shall assess at the end of each reporting period whether there is any objective evidence that a financial asset or a group of financial assets is impaired or become uncollectible. In the case of Loan Shark, if there is a breach of contract such as default or delinquency in interest or principal payments, it gives rise to evidence that the account may become uncollectible. Jacob has incentive not to record bad debt expense, as the relating contra AFD account will decrease the AR balance. And since AR balance is adjusted for AFD in the purchase price, this will result in a lower purchase price for Jacob. We recommend using 10% of the outstanding receivables balance at the end of the year for the bad debt calculation, rather than 10% of the payday loans advanced, because the outstanding balance provides a more reliable estimate of the amount not collected at year end, opposed to the full amount of the payday advances. So therefore, a bad debt expense and an AFD account of $107,000 should be recognized. The allowance for doubtful accounts recognized should be allocated in the following method. 20% of it should be allocated to the interest receivable, which equals $21,000, and 80% of it should be allocated for loans receivable, which totals $85,000. After all the accounting adjustments are made, the income statement will look like the following. Only interest revenue will be included. The previously written off collections of $89,000 will be removed from revenue. A bad debt expense of $107,000 will be recognized. The donation of $17,100 is removed from expenses, and the collection fee is also removed from expenses. Therefore, the adjusted purchase in accordance with IFRS will be $391,000. It includes 60% of the interest receivable adjusted for allowance for doubtful accounts, which equals $115,000, and 50% of the revenue from paid advances, which equals $276,000, which gives us our new purchase price. The second option is to sell to a third party. And since past MLI stores have been able to sell their accounts receivable and franchise rights for 10 times normalized after-tax earnings, we calculated that after removing the one-time IT expense caused by the tornado and adjusting Jacob's salary to that of one that would be paid to a regular employee doing the same amount of work, the normalized earnings of Loan Shark appears to be $152,000. Therefore, the purchase price for option 2 is as following. It's $152,000 times 10, which equals $1.5 million. So if Jacob is able to sell to a third-party company for $1.5 million, he should accept this offer, as it is much higher than what he would receive from the franchisor. This would be a good time to sell, as business is booming due to the recession. But the recession also increases collectability risk. Therefore, it may be hard to sell to a third party.
Lastly, I will be talking about a significant fraud concern. The new employee, who has only been on the job for 6 months, appears to be running a Ponzi scheme. He has a large number of repeat customers, most of who default at the initial stage, but he manages to collect before the accounts are sent for outside collection. He has a high initial default rate of 70% and a high delinquent accounts collection of 80%, both of which are significantly higher than the team average. There's also no bonus or commission program in place, so there's no incentive for employees to maintain such repeat customers. So this new employee is engaging in a practice whereby he's allowing those customers to borrow more money in order to pay off their own debt. In other words, he is granting out new payday advances for those customers to pay back their previously outstanding loans. This scheme results in no legitimate earnings, and it will eventually collapse and consequently hurt the bottom line. So per CAS 240, it is important for management to prevent and detect fraud as much as possible. Hence, combined with the previously mentioned control recommendations, this employee should have a full review of his files triggered to verify if a Ponzi scheme is in fact taking place. If so, the employee should be relieved of his duties. Better controls need to be put in place to ensure a similar situation does not happen again. For example, a more rigid screening should be performed on potential employee candidates to determine their history and background. Supervisors should perform more frequent reviews of employee transactions and set up controls for large amount loans. Better controls for customers applying for a payday loan should also be present to ensure that all customers are legitimate. So this concludes our report to you, Mr. Singla. Thanks for listening.